Good morning. Welcome to the XM.com weekly market update. And we're joined once again by Peter McGuire, the CEO of XM. Good morning, Pete.
Good morning, Andrew.
Before we get into these numbers, just give us a bit of a wrap of what you're hearing out in the market. I know you work with a few other media organisations. What's sort of the word on the street, if you like?
Well, if we come back this morning, a couple of hours ago I did with Brian Curtis, you know him well, from Bloomberg out of New York for Bloomberg Asia Daybreak Radio, talking about what's happening with China. The Microsoft earnings and Amazon versus the likes of Google and how's that all transpired and washed over the NASDAQ. It's been an incredible 7-month rally to the upside. Also, we spoke about China, what happens as far as stimulus and will we see something? If you're looking at the footprint of Asia, how come Japan's doing so well? It's really performing incredibly well. You've got Ueda, the minister, where he's going to roll as far as policy moving forward. So we spoke with those guys this morning, spoke with yesterday Ausbiz, the day before Bloomberg out of Dubai on Sunday, CNBC Arabia out of Dubai on Friday. Now they're conscious as far as energy, what's going on with the footprint across Saudi, OPEC, because they're all dependent on oil revenue, of course, yes. And the overall themes with US dollar, what's happening geopolitically, are there any hiccups about to enter the market? So yeah, there's a lot you glean a lot when you talk globally, and with 10 million plus clients and our breakfast shows each day, there's a lot of commentary and a lot to take on board, as you only too well know.
Yeah, very much so. And there's, as you say, there's multiple markets there. There's always ebbs and flows, and
yeah.
there's always a speed bump around the corner.
Always.
And how severe that will be, no one ever knows. But I guess that's financial markets, isn't it?
Yeah, it is. Yeah, and 24 hours a day, 5 days a week, or 6 days a week. So it's game on.
Yeah. All right, well, let's just look domestically. We had the RBA last week. They kept their interest rates on hold, which was a little bit of a surprise. But what's not a surprise is where the Aussie dollar is on the back of that.
No, well, we said it last week, about this time last week, and we were both in the camp that they'd raise rates anyway. They didn't. We said if they don't raise rates, the Aussie will come under pressure to the downside, and there it is, 65, 70, 65, 60 sort of level, and possibly even softer from here unless China gets a giddy up. That US dollar index sitting up still above 102, so yields, maybe we're going to see with the inflation read coming out on Thursday from the States, it'll be an interesting number. Yeah,
for sure. And looking at China, obviously that has a huge impact on what happens domestically. Oh. But we've spoken about it before, GDP down, CPI not down, but at very low levels. You've got the ageing population.
100%.
You've got the property issues.
Yep.
You've got the youth unemployment,
the youth
which is sort of around 20-25% or something, which
is
huge.
Yes, when you're talking about social unrest, that's always a concern for any government, especially the size of China with that much of a large footprint of young people trying to earn a dollar. It's very, very worrying for them.
Yeah, sure is. Now, if we go over to the UK, interest rates have gone up again, another 25 basis points, which was needed, and I suspect they will probably need a bit more.
Yeah, that chart, it's like Stairway to Heaven. Is it going to continue? And I'd like to look forward to seeing it in about another 3 months' time if you're going to see those continuations. We hit 7.9% as far as inflation, so that was a good thing. You broke 8%, but with higher energy prices, could we see a little bit further of a bounce to the upside? So, interesting trade, the pound, interesting trade, pound, euro, game on, cross rates.
Yeah, for sure. Talking about the CPI coming down, which is a good thing, but clearly still too high, which goes into the narrative of, you would think, much higher interest rates.
Yep. So I don't want to call it, but I think that's what you're going to see, and how many more for this 23? You've got 5 months to run, or 4 and a bit months to run.
You would think at least a couple.
You would think so. I don't want to upset the POMs that are watching the show, but it could well be the case.
Yeah, for sure. Interesting here, looking at this chart, this is obviously the S&P and the pound. It's incredible, the correlation there.
Yes, exactly right. So, the S&P's been on a trajectory, 4,500, and it's strongly bid at the moment. I thought it's had quite a good year, considering where it started and where it is at the moment. We're only 7 months in or so. And then you're looking at the pound versus US dollar. That's been an almighty trade as well. We saw the low, we called it here that day at 103 when it bounced, and then it's, well, where is it now? The best part of 130, 127 sort of range. So it's dynamic, and you want to make a dollar, currencies aren't a bad place to start.
Yeah, plenty of volatility, which is what they like.
Yep.
US non-farm payrolls came out 187,000, which was slightly lower than what they were expecting, but still, as we've said many, many times, the economy there and the job market is extremely resilient.
Extremely resilient. Hit one, as you said, 187. Analysts were forecasting 200. They revised down May and June. So let's just see where that all rolls. And yeah, we sit here and see where the rest of summer takes us.
Yeah, and obviously the CPI is coming out this week as well. So there's talk that it'll be slightly higher than the 3% from last month, but that comes out tomorrow, I believe. So Thursday.
Have a look at the Cleveland Fed, because they've got an index and an analyst watch, and the analysts watch it, and it's normally very close to getting it right. It's a top pick. So yeah, I'm just looking forward to seeing how that drops in 48 hours.
Yeah, and they're anticipating that it
could be
slightly higher.
Yeah,
for sure. Interesting chart here I found as well, which looks at the S&P over the last 12 decades. So it obviously splits it out.
When you were a boy,
well, yeah,
you'd remember 1900s, a bit before my time, Andrew. But
maybe. But you look at those annual returns over 12 decades. There's only 2 negative decades, which
incredible.
is pretty incredible. Which goes to the thesis of patience in the share market. Is a good thing.
Yeah. Many older traders will tell you that. And when you look at the 30s, I mean, that was after the Depression and right in the heart of it. And you also had a world war and what was it, October 29 meltdown. So really, to be down only 0.8% at the end of that were your annual returns over the 10-year window, and it bounced certainly in the 40s, and then 50s it was game on, 20%. What was interesting was the 80s and the 90s when you analyse that. Reagan era and strong push, and you were coupled that with the 90s as well, with that huge, tech boom and everything moving right. 2000s, well, you had started off naturally with, after that strong 2 decades of growth, but you had 9/11, and then finished it with the middle of 08 with the GFC, and that ran for a number of years. So that wasn't a bad number really to consider, down 1.2% for that 2000 to 2010 window.
Yeah. So no, it's an interesting chart, and you sort of look at what's happening, particularly in the US at the moment, and we're right in the thick of earnings season as well.
Yep.
And once again, it's been reasonably good.
Reasonably good. Yep. So. Yeah, and that's been demonstrated by the S&P, certainly the Dow and the Nasdaq. I thought they've all performed very well, and that's what traders are enjoying, trading those indexes.
Yeah, for sure. Finally, just to look at this interest rate market, which is. It's sort of interesting where these rates are now at. So we saw that big fall in March. The twos went from above 5% to below 4%, which was a massive drop off. And now both the twos and the tens have crept up quite a bit, which doesn't necessarily talk about interest rates going a lot higher. But I suspect where they are at the moment, we might stay at these levels quite a bit longer than what the market was anticipating.
That's what everyone's saying. And we spoke about that this morning with Bloomberg, that if you get a higher read, then you might see more pressure to the upside as far as the Fed. And of course, yields will continue to climb, and that will be good, naturally, for US dollar.
Yeah, well, it certainly would support it for sure. But we'll keep an eye on that one as well. Plenty of data coming out, and obviously the big one is the US CPI.
Yep.
See where we land after that.
Yeah, the rest of the week, we're just sitting here, having a look, seeing how it all drops. But I think this month will be an interesting month. August normally is, and there's a series of very, very bad storms on the east coast of America, so I wonder what that's going to do. So it could be disruption to the markets or disruption to property and so on. Yeah, Hope everyone's safe.
Yeah, all right, we'll keep an eye on things, and we can regroup next week.
Look forward to it.
Great, thanks Pete.
Cheers, Andrew.
And that's the XM.com weekly market update.